It is not that easy to determine which funds to use for a long-term investment, especially if your employer has an option for 401k. Choices can get really overwhelming. It is not that easy to understand how each fund varies and which will be the most beneficial for your exact situation. Nowadays, we have a lot of choices to invest, so it can become annoying and irritating to even think about which one is correct fund for you. Many people do not have a lot of information about investing or do not want to waste their time learning about all the different options and just want a stable investment which will provide the returns they are looking for. They just want to reach their investment goals. One of the most popular funds available is the one you probably already know or at least heard of, and as we later will figure out, for a reason. It is of course S&P 500 Index Fund. This is the indication how well US stock market is performing. But you might ask, what is exactly S&P 500 and is it a most ideal place to invest your money for you? Let's start analyzing it and decide if it is worth adding to your portfolio as an investment. It is Gentleman's Finance channel. Here we learn about different business opportunities, how to make money and invest wisely. Here you will also learn how to increase your wealth and become debt-free. All men should take care of their own finance. If you are interested in accumulating wealth and improving your financial future, make sure to subscribe this channel and hit a like button. Also comment down below I subscribed and I will try to answer all of your comments. Let's start from the basics. Index basically measures the performance of a stock market. Different index funds can track different markets. For example, Nasdaq 100 tracks 100 largest companies by modified market cap that trade on Nasdaq exchanges in the basic materials, consumer discretionary, consumer staples, healthcare, industrials, technology, telecommunications. And S&P 500 tracks the performance of 500 largest companies listed on stock exchanges in the US. S&P 500 covers most areas of the US market, including roughly 80% of the available market cap. For this reason, it is usually looked as gauge of the market. This basically means this index fund is the closest indication of the overall market and is neither better, neither worse than average. This is the important detail to remember, because S&P 500 is a passive form of investment. It is not actively managed mutual fund which is designed to beat the market. Instead, it is designed to track an index, an average. So in this case, 500 largest companies in the US. In other words, this index fund moves together as the companies grow. And because of its passive management, you can own it for a little cost. The cost of owning this could be as low as 0.3% or $300 per year for each $1 million investment. It is really not much if you ask me. How does the S&P 500 work? It is a lot simpler than you might think. If you decide to invest into S&P 500 index fund, you own shares of all 500 large cap stocks that make up the index. Those companies can change if the S&P 500 drops or changes the companies in the actual index. One more important thing to know, that the S&P 500 index is quite well diversified, which of course is a big plus for investing. It has investments of 11 different sectors and no sector having more than 30% money invested. This fund is quite reassuring since many funds are invested in sectors like financials, industrials, technology, healthcare, etc. This provides us, investors, with broad diversification immediately without having to learn a lot about investments. So let's dive deeper and look at sectors which make the index. The largest sector held at this index is technology sector. Technology sector takes about 28% of the total index. This is quite a lot. However, technology seems like evergreen sector. It is always evolving and therefore growing. We use our technologies in almost every aspect of our lives. Second largest sector in S&P 500 index is healthcare, which takes about 13% of the total index. Healthcare sector includes companies like Johnson & Johnson, Pfizer, and more. Thirdly, consumer discretionary makes about 12% and includes companies like Netflix, Starbucks, and Disney. Fourth largest sector is financials, and it makes about 11.5%. This sector includes companies like Visa, MasterCard, Bank of America, and more. Fifth largest sector is communication services, which includes Horizon, Cisco, and more. Next, we have industrials. It includes companies like Boeing, Union Pacific, and more. Seventh largest sector is consumer staples and takes about 6.2% of the total index. Number 8 is utilities and includes companies like Edison International, Nextera Energy, and more. Number 9 is real estate and includes companies like Crown Castle International, Welltower, and more. Number 10 is energy, which includes Valero, Marathon, Hess, and more. And the last one is materials, and it produces chemicals, construction materials, etc. Also, if you are interested in top companies in this index, I will gladly share it with you. Top companies which are held in S&P 500 are Apple, Google, Amazon, Johnson & Johnson, Microsoft, Berkshire Hathaway, Procter & Gamble, Visa, Facebook, Tesla, and more. Top companies which are tracked in this particular index fund accounts for 25% trading activity, as well as returns on investment, of course. So although index holds 500 companies, all companies are not equally weighted and have different impact on S&P 500 index fund performance. Now, what are the advantages of investing in the S&P 500? One of the advantages is that each company must meet certain criteria to be included. In simply to understand words, before any of the companies are added to this index fund, they are analyzed by the US Index Committee to ensure they meet the requirements of specific financial measures to be suitable for the S&P 500 index inclusion. Those are: company should be US company, have a market cap of at least $12.7 billion, be a liquid company, have a public float of at least 50% shares outstanding. Recent quarter's earning must be positive. So, should you invest in S&P 500 index fund? Let's talk about pros and cons. Because index is passively managed, it is very low fees option. It is also quite a diversified fund. However, talking about the cons, all index funds have not as good return of investment since it goes just as the market goes. If you just want a diversified portfolio with average returns, this might be for you. If you want an index which beats the market and gets a better returns, this index might be not for you. To give you a little bit more information, let's talk about average return of investment of S&P 500. For the last 30 years, S&P 500 returned about 10%. This is certainly not bad compared that it is lower risk, good diversification index. So in conclusion, what is the best investment for you depends on your age, risk tolerance, how much money you have, when you want to retire, and more. So in my opinion, S&P 500 can be a great place to park your money, especially if you are just new to investing and do not know a lot about this area. Thank you for watching this long video. If you found any value, like and subscribe.